Welcome to the appendix of Chapter 10. As we discussed in our standard cost variance lectures, the product costs are made up of direct materials, direct labor, variable overhead, and fixed overhead. And we went over how to calculate the price and quantity variances for the variable components of product costs. This segment is going to discuss how to calculate the variance for fixed overhead, the only fixed cost that's part of our product cost. The reason the fixed costs are different is because they behave differently than variable costs. Remember, total fixed costs stay the same, and on a per unit basis they change, which is the opposite of what variable costs do. So the approach is similar but a little different. So let's get started. So the first thing to understand is there's still a three-column approach, but the three columns are different. The first column is actual fixed overhead, and the second is budgeted fixed overhead. The first column has no real formula because fixed overhead is just fixed. It's not based on any driver. So whatever the actual fixed overhead number is, that would go into column 1. In column 2, we'd have budgeted fixed overhead. Budgeted fixed overhead is going to be referred to as our denominator hours times our fixed rate. Well, if you remember, our predetermined overhead rate equals estimated overhead over estimated activity. This goes way back. So the denominator hours are what we're referring to as estimated activity in this denominator. So denominator hours are really the estimated activity. That's the direct labor hours or machine hours or direct labor cost. That's the driver of our overhead. The fixed rate is going to be the fixed portion of that predetermined overhead rate. We'll talk more about that in a bit. Comparing our actual to our budgeted fixed overhead gets us our budget variance. If actual is more than budget, that's bad and it's unfavorable because we want to keep our costs down. If actual is less than budget, that would be good and it would be favorable. The algebraic format of that is just the difference between actual and budgeted fixed overhead. There aren't any further breakdowns because actual fixed overhead is just a number that's given. You can't really break it down into components. The difference between the budgeted fixed overhead and the fixed overhead applied is called our volume variance. The fixed overhead applied is going to be our squap times our fixed rate. Our fixed rate effectively is like a standard price because remember the fixed rate is just the fixed portion of the predetermined overhead rate. So it's really like our standard price. When we did variable overhead, the variance there, SP, represented the variable portion of the predetermined overhead rate. So FR, or fixed rate, is really just the standard price. And then squap is going to be the standard allowed per unit times actual production. And you might say, well, standard allowed of what? And the answer is the standard allowed of the driver. So whatever that driver is, if it's direct labor hours or machine hours, it's the standard allowed per unit of those machine hours or direct labor hours times the actual production. So here it is with the formulas typed up. The difference between your budgeted fixed overhead and your fixed overhead applied, the difference between those two columns are the hours. Denominator hours are really the estimated, or let's say it this way, the standard allowed per unit times planned activity whereas the standard hours are our squap, which is the standard allowed per unit times actual activity. So the only reason there's a difference between the budgeted fixed overhead and the fixed overhead applied is because our planned activity and our actual activity is different. When we have budgeted fixed overhead greater than the overhead applied, that's going to result in an unfavorable variance because it means we planned to make more than we actually did. That means we weren't very efficient at utilizing our factory. When the budgeted fixed overhead is less than the applied, that is a favorable variance because it means we made more than we originally planned, so we utilized our factory effectively. So if you treat the left as the actual and the right as the budget, the FUs still work as normal, but it's kind of weird to treat a column called budgeted fixed overhead as actual. So that's why I don't really teach you that way. It's really comparing the planned activity to the actual activity. When we make more than we planned, that is when the overhead applied is greater than the budget, that's favorable. Making more than you plan is a good thing. You're utilizing your factory well. When you make less than you planned, or when planned is bigger, then that's unfavorable because you're not effectively using your resources. So that's a little tricky to get used to. Let's go through an example for Colico. We have budgeted productions, 30,000 units. Standard machine hours a unit is 3. That's going to be our driver for overhead. Budgeted machine hours for the year are 90,000. Actual production is 28, which means our SQAP is 84. This would be the 3 times the 28,000 actually produced. And then our actual machine hours are 88. So how does all this pan out? Well, our budgeted variable overhead is 90,000. Our budgeted fixed overhead is 270. Again, this is our data that's provided, which gives us our total budgeted overhead of 360. That's what we're going to use to calculate our predetermined overhead rate. Our actual variable overhead was 100, our actual fixed was 280, and our total overhead was 380. So the first thing we can do is calculate our predetermined overhead rate, which is estimated overhead over estimated activity. So our estimated total overhead was 360, and our estimated total activity was 90,000 machine hours, which gives me a predetermined overhead rate of 4. I can't use this 4 to calculate any of my variances because remember, our overhead variances are broken up into fixed and variable components. That means I need to break up my predetermined overhead rate into its fixed and variable components. To get the variable part, I include only the variable overhead in the numerator. To get the fixed part, I include only the fixed overhead in the numerator. You'll notice that the variable of $1 and the fixed of 3 added up gives us that $4 predetermined overhead rate for the company overall. But we need to know the breakdown of our fixed and variable rates in order to calculate our variances. When we apply overhead in a standard cost system, it's a little different than in a traditional system. In a traditional system, which we learned up to this point, the applied overhead equals our predetermined overhead rate times actual activity. In a standard cost system, overhead applied is the predetermined overhead rate times our SQAP. That's our standard quantity allowed for actual production. So that's a little different than under a traditional system. When we're using standards and we apply overhead, we base it on the standard hours allowed for actual production. So you can see the overhead applied comes up to 336 in total. Let's break up our variances. So our budget variance is the difference between the actual fixed overhead and the budgeted fixed overhead. Because our actual fixed overhead was 280, that was given, and our budgeted fixed overhead was 270, also given, we can see that we have a $10,000 difference. That $10,000 is unfavorable because the actual was greater than the budget. Spending more money is always bad. For the volume variance, we could use the formula, which is budgeted fixed overhead minus the fixed rate times the SQAP. Standard quantity allowed for actual production. Again, I don't like the algebraic method. I'll show you the 3-column approach in a minute. But if we did this, we would calculate our overall variance. And because I like the 3-column approach, I need to know what the 84,000 times 3 comes out to be. That's 252,000. And because our budget is greater than our applied, it means we plan to make more than we actually did, which is why we have an unfavorable variance. Whenever budget is greater than applied, it means we plan to make more than we actually did, which is a bad thing. If we budget less than we apply, then it means we made more than we planned, which is a good thing. So basically, you could figure out your F's and the U's if you compare your denominator hours to your standard hours. When your denominator hours are greater than your standard hours, which is the case here, we're going to have an unfavorable variance because I plan to make more than I actually did. When my denominator hours are less than my standard hours, then we have a favorable variance because it means I actually made more than I had planned. Remember, denominator hours are based on planned activity, whereas standard hours are based on actual activity. So our volume variance comes out to 18,000 unfavorable. We can also calculate it by taking the rate and then comparing our actual, our denominator hours and our standard hours allowed, which is effectively SQUAP. I don't care for any of this. This is the approach I would take each and every time. I love my 3-column approach. Actual fixed overhead was given. The budgeted fixed overhead was given. And we know that we could break this down into denominator hours times fixed rate. The denominator hours was 90,000 we estimated at the beginning of the year, and the fixed portion of the predetermined overhead rate was 3. For the applied hours is the SQUAP, which was 86,000 times the fixed rate, which was 3. And that's where the 250, in a minute. I think I might have got my SQUAP wrong. And I did. I have a bad memory, apparently. So SQUAP was 84,000. 84,000 times 3 gives me my 252. Because my denominator hours were bigger than my standard hours allowed, that's why my volume variance is unfavorable. Combined, the budget variance and the volume variance, 2 unfavorables, gives me a bigger unfavorable, which is also the difference between column 1 and column 3. So you can still check your work when you're dealing with fixed overhead variances. The sum of the budget and volume variance would equal the total variance. Let's take a look at a graph of fixed overhead. So we have our budgeted fixed overhead. Notice it's a flat line. It doesn't change based on activity. And then we have our fixed overhead applied at a basis of $3 per standard hour. Our actual overhead's 280, so that's where our budget variance is. We spent more than the budget by 10,000, so that's why we have a 10,000 unfavorable budget variance. Our volume variance is a function that we produced less than we had planned. So even though we planned to produce at 90,000 denominator hours, we only produced at 84,000 SQUAP hours. So that's what resulted in our volume variance, which is one unfavorable because we produced less than we planned. So in short, in a standard cost system, unfavorable variances are the equivalent to underapplied overhead. It means we applied too little. Favorable variances are the equivalent to overapplied overhead. So the sum of our overhead variances is going to give us our under or over applied overhead cost for the period. So that's something important to remember. It's easy to remember because unfavorable and underapplied both start with U. So that's how I remember which is which. If you have an overall unfavorable variance, it means your overhead was underapplied. If your overhead is favorable, if you have a favorable variance, then you have overapplied overhead. So looking at Cola Company again, we have their predetermined overhead rate, the SQUAP of 84, the overhead applied of 336 in total, and the actual of 380. And then manufacturing overhead is under or over applied by 44,000. The reason it's under applied by 44, if you remember back to when we did an overhead T account, where actual is on the left and applied is on the right. The actual manufacturing overhead is 380. The applied was 336. So the difference ends up being on the debit side, 44. And when we have a debit balance, it means the overhead is under applied. We didn't apply enough. You may remember Drew and Crow. Debit balances are under applied, credit balances are over applied. So real quickly, the variable manufacturing overhead rate variance is calculated as 12,000 unfavorable using the algebra. Again, I'm not a huge fan of the algebra. I would probably do actual quantity times actual price, actual quantity times standard price, standard quantity allowed for actual production times standard price. The actual variable overhead was 100,000. The actual hours were 88,000 and the standard was $1, so that gives me 88 total for my middle column. And then the difference is 100,000 minus 88,000, and that's where the 12,000 unfavorable variance comes from, because we spend more than budget. For SQAP, that, let me see if I get it right this time, was 84,000 times $1, so that comes out to 84. So that means our efficiency variance is going to be 4,000, and that's going to be unfavorable as well, because I spent 88 when I was allowed to spend 84, or I used 88,000 hours when I was allowed to use 84. And there it is in algebraic form, the 4,000 unfavorable efficiency variance. Why are we showing you this? So we can give you the grand finale, which is to show you that if we take our variable overhead rate variance, our variable overhead efficiency variance, our fixed overhead budget variance, and our fixed overhead volume variance, and we add them together, because they're all U, we can just add them all, and we get an overall 44,000 unfavorable variance, which represents the 44,000 under applied overhead that we had previously calculated. So what you should learn from this is if we add up all of our overhead variances, we can calculate our over or under applied overhead for the period. If you have a bad memory like me, let me just go back. There's the T account where we have actual and applied, and there's the 44,000 under applied overhead. And that we can also calculate by combining all of our overhead variances to arrive at the same conclusion. So again, the sum of all of our overhead variances will equal the amount of over or under applied overhead for the period. And that's it for the appendix. As always, practice makes perfect. Please use the practice resources both on Canvas and Connect to further your understanding and learning, and reach out to the discussion boards or to me directly with any questions you may have.